Question 1. The primary purpose of an annuity is to A. Provide a death benefit to a beneficiary upon the annuitant's death. B. Offer a guaranteed rate of return on invested capital regardless of market conditions. C. Accumulate funds for retirement and then liquidate an estate, protecting against outliving one's income. D. Serve as a low-cost alternative to traditional life insurance policies. Answer: C. Accumulate funds for retirement and then liquidate an estate, protecting against outliving one's income. An annuity is fundamentally designed to help individuals save for retirement on a tax-deferred basis, which is the accumulation phase, and then provide a guaranteed stream of income, known as annuitization, for a specified period or for life. This income stream acts as a safeguard against the risk of outliving one's savings, often referred to as longevity risk, making it a powerful tool for retirement planning. Think of an annuity as a financial product that first helps your money grow, and then turns that money into a steady paycheck you can't outlive. Question 2. Which type of annuity payment option provides the highest possible income payment to the annuitant but ceases all payments upon the annuitant's death, regardless of how soon it occurs? A. Life with period certain. B. Joint and survivor. C. Straight life. D. Installment refund. Answer: C. Straight life. A straight life annuity, also known as a pure life annuity or life only, maximizes the periodic income payments to the annuitant because the insurer has no obligation to continue payments to beneficiaries after the annuitant's death. This option carries the risk that if the annuitant dies shortly after payments begin, the remaining value is forfeited, but it offers the highest payout during the annuitant's lifetime. If you want the most income during retirement and are willing to take the risk of no money going to heirs if you die early, this is the option for you. Question 3. An individual purchases an annuity and plans to begin receiving income payments immediately, within 1 year of the purchase date. This type of annuity is known as A. Deferred annuity. B. Flexible premium annuity. C. Immediate annuity. D. Variable annuity. Answer: C. Immediate annuity. An immediate annuity, often purchased with a single lump sum premium, is specifically designed to begin providing income payments to the annuitant within 1 year of the purchase date, typically within a month. The key clue here is immediately and within 1 year, which differentiates it from a deferred annuity where payments begin at a later date. This type of annuity is suitable for individuals who are already retired or are nearing retirement and want to convert a lump sum into a steady income stream right away. Question 4. All of the following are characteristics of a fixed annuity except A. Guaranteed minimum interest rate. B. Payments invested in the insurer's separate account. C. Level benefit payout options. D. Funds are held in the insurer's general account. Answer: B. Payments invested in the insurer's separate account. Fixed annuities guarantee a minimum interest rate and provide a level benefit payout, with the funds held in the insurer's general account, meaning the insurer bears the investment risk. The characteristic of payments being invested in the insurer's separate account is unique to variable annuities, where the annuitant bears the investment risk, and the payout can fluctuate based on the performance of the underlying investments. Remember, fixed means stable and predictable, while variable means it fluctuates and requires a securities license to sell. Question 5. In a non-qualified annuity, how are withdrawals taxed when taken prior to annuitization? A. All withdrawals are tax-free. B. The principal, cost basis, is taxed first, followed by earnings. C. Earnings are taxed first, LIFO, last in, first out, followed by the principal. D. Withdrawals are always penalized, but never taxed. Answer: C. Earnings are taxed first, LIFO, last in, first out, followed by the principal. For non-qualified annuities, the last in, first out, LIFO, rule applies to withdrawals made before the annuity has been annuitized. This means that any earnings are considered to be withdrawn first and are subject to ordinary income tax, and potentially a 10% penalty if the annuitant is under age 59 and a half, before the tax-free return of principal, the original contributions, begins. This LIFO treatment is a crucial tax concept to remember for annuities, as it impacts how early withdrawals are taxed. Question 6. What is the accumulation period of an annuity? A. The period during which the annuitant receives income payments. B. The period during which premiums are paid into the annuity and grow on a tax-deferred basis. C. The period after which surrender charges no longer apply. D. The period over which the annuity's value is completely paid out. Answer: B. The period during which premiums are paid into the annuity and grow on a tax-deferred basis. The accumulation period is the phase in an annuity's life cycle when the contract owner makes premium payments, either in a lump sum or periodically, and the funds within the annuity grow tax-deferred through interest, dividends, or investment gains. This period continues until the annuitant decides to annuitize the contract and begin receiving income payments, or until they surrender the contract. Think of it as the savings, or growth, phase before you start drawing income. Question 7. An annuity contract owner is considering surrendering their annuity early. What is a surrender charge? A. A penalty applied if the annuitant dies within a certain period after annuitization. B. A fee charged by the insurer for managing the annuity's investments. C. A penalty charged by the insurer for early withdrawal or termination of the annuity contract during the accumulation period. D. A tax imposed by the IRS on annuity distributions before age 59 and a half. Answer: C. A penalty charged by the insurer for early withdrawal or termination of the annuity contract during the accumulation period. A surrender charge is a fee imposed by the insurance company when an annuity contract owner withdraws money from the annuity or fully surrenders the contract before a specified period, typically ranging from 5 to 10 years, has passed. These charges are designed to compensate the insurer for expenses incurred in issuing the contract and to discourage early withdrawals, which can disrupt the insurer's investment strategies. Always be aware of surrender charges before signing an annuity contract. They can significantly reduce your payout if you need access to your money sooner than planned. Question 8. All of the following statements about variable annuities are true except A. They require the agent to hold both a state life insurance license and a FINRA, or formerly NASD, securities registration. B. Their cash value and death benefit may fluctuate based on the performance of the separate account. C. They guarantee a minimum interest rate and a level income payout. D. The annuitant bears the investment risk. Answer: C. They guarantee a minimum interest rate and a level income payout. Variable annuities do not guarantee a minimum interest rate or a level income payout because their performance is tied directly to the underlying investments within the separate account, which are chosen by the annuitant. This means the annuitant bears the investment risk, and consequently, the agent must hold both a state life insurance license and a FINRA securities registration to sell them. The fluctuation of cash value and potential death benefit is a defining characteristic of these products. Question 9. What is an exclusion ratio in the context of annuity taxation? A. The ratio of the annuitant's age to their life expectancy, used to determine tax penalties. B. The percentage of each annuity income payment that is considered a tax-free return of premium. C. The percentage of the annuity's earnings that is excluded from taxation. D. The ratio of investment gains to losses within a variable annuity. Answer: B. The percentage of each annuity income payment that is considered a tax-free return of premium. When an annuity is annuitized and payments begin, the IRS allows a portion of each payment to be received tax-free because it represents a return of the original principal, the premiums paid. The exclusion ratio is the formula used to determine this non-taxable portion, calculated by dividing the annuitant's investment in the contract by the expected total return. This ratio remains constant for the life of the annuity, ensuring that only the earnings portion of each payment is subject to income tax. Question 10. A deferred annuities annuitization phase typically begins: A. Immediately after the first premium payment. B. After a specified period, usually more than 1 year from the purchase date. C. Only upon the annuitant's death. D. When the annuity reaches its maximum guaranteed value. Answer: B. After a specified period, usually more than 1 year from the purchase date. A deferred annuity is characterized by its two distinct phases: an accumulation phase, during which funds grow tax-deferred, and a payout, or annuitization, phase that begins at a future date selected by the annuitant, typically more than 1 year after the contract is purchased. This contrasts with an immediate annuity, where payouts begin within 1 year. Deferred annuities are ideal for individuals who want to save for retirement over time and defer receiving income until a later point in their life. Question 11. Which annuity payout option guarantees income payments for the annuitant's life, but if the annuitant dies before a specified period, e.g., 10 or 20 years, payments continue to a beneficiary for the remainder of that period? A. Straight life. B. Joint and survivor. C. Life with period certain. D. Installment refund. Answer: C. Life with period certain. The life with period certain annuity payout option provides income payments for the annuitant's entire life, but it also guarantees that payments will continue for a minimum specified period, such as 10 or 20 years, even if the annuitant dies sooner. If the annuitant dies before the period certain expires, the beneficiary receives the remaining payments for the balance of that guaranteed period. This option balances lifetime income with a guarantee of payments to beneficiaries, making it a popular choice. Question 12. What is the role of the owner in an annuity contract? A. The person who receives the income payments from the annuity. B. The person or entity who purchases the annuity and has all rights to the contract. C. The person or entity designated to receive any remaining value upon the annuitant's death. D. The insurance company that issues the annuity contract. Answer: B. The person or entity who purchases the annuity and has all rights to the contract. The owner of an annuity contract is the individual or entity who holds all the contractual rights, including the right to name the annuitant, beneficiary, change payout options, make withdrawals, or surrender the contract. The owner is not necessarily the annuitant, although they often are the same person. Think of the owner as the person in charge of the annuity, controlling all decisions related to it. Question 13. Which of the following is a common risk associated with fixed annuities? A. Investment risk, as the principal value can fluctuate with market conditions. B. Inflation risk, where the purchasing power of fixed payments may decrease over time. C. Longevity risk, where the annuitant might outlive their income. D. Credit risk, if the annuitant fails to make premium payments. Answer: B. Inflation risk, where the purchasing power of fixed payments may decrease over time. While fixed annuities offer guaranteed interest rates and predictable income streams, they carry inflation risk because the purchasing power of their level payments may diminish over time due to rising costs of goods and services. This is a crucial consideration for long-term retirement planning, as a fixed payment that seems adequate today might not be sufficient years down the line due to inflation eroding its value. Question 14. An annuity purchased with a single, large sum of money is called A. Flexible premium annuity. B. Variable premium annuity. C. Single premium annuity. D. Recurring premium annuity. Answer: C. Single premium annuity. A single premium annuity is purchased with one large, lump sum payment, unlike a flexible premium annuity, which allows for multiple payments over time. This type of annuity is often chosen by individuals who have received a significant sum, such as an inheritance, a severance package, or proceeds from a property sale, and wish to convert it into a guaranteed income stream. It's a quick way to fund your annuity if you have a substantial amount available. Question 15. The 10% IRS penalty for early withdrawals from a non-qualified annuity typically applies to withdrawals made by an annuitant before what age? A. Age 65. B. Age 59 and a half. C. Age 70 and a half. D. Age 50. Answer: B. Age 59 and a half. The IRS imposes a 10% penalty tax on the taxable portion of withdrawals from non-qualified annuities if the annuitant is under the age of 59 and a half, in addition to ordinary income taxes. This penalty is designed to discourage the use of annuities for short-term savings rather than their intended purpose of long-term retirement planning. Always advise clients about the tax implications and potential penalties of early withdrawals from annuities. Question 16. What is the main difference between a joint life annuity and a joint and survivor annuity? A. Joint life provides higher payments but stops at the first annuitant's death, while joint and survivor continues payments for the survivor. B. Joint life is only for married couples, while joint and survivor is for any two individuals. C. Joint life guarantees payments for a period certain, while joint and survivor does not. D. Joint life offers a death benefit, while joint and survivor does not. Answer: A. Joint life provides higher payments but stops at the first annuitant's death, while joint and survivor continues payments for the survivor. The core difference lies in how long payments continue. A joint life annuity provides income payments for the lives of two or more annuitants, but all payments cease upon the first annuitant's death, offering a higher initial payout. In contrast, a joint and survivor annuity also covers two or more annuitants but guarantees that payments will continue to the surviving annuitant, often at a reduced amount, after the first annuitant dies, providing more security. If protecting the survivor is key, joint and survivor is the choice, even if it means slightly lower initial payments. Question 17. An indexed annuity offers a return that is tied to a stock market index, like the S&P 500, but also provides A. Unlimited upside potential with no caps on gains. B. A guaranteed minimum death benefit. C. A guaranteed minimum interest rate, floor, regardless of index performance. D. Daily access to the invested funds without surrender charges. Answer: C. A guaranteed minimum interest rate, floor, regardless of index performance. Indexed annuities offer a unique blend of features, providing potential gains tied to a specific stock market index while simultaneously protecting the principal by guaranteeing a minimum interest rate, also known as a floor, even if the index performs poorly. This means you can participate in some market upside without the risk of losing your principal, unlike direct stock market investments. It's a popular choice for those seeking growth potential with principal protection. Question 18. An annuity's free look period allows the contract owner to A. Make unlimited withdrawals without penalty. B. Annuitize the contract at any time without prior notice. C. Return the contract for a full refund within a specified number of days after delivery. D. Change the annuitant or beneficiary without insurer approval. Answer: C. Return the contract for a full refund within a specified number of days after delivery. The free look period, also known as a right to examine period, is a mandatory provision in most insurance contracts, including annuities, that allows the contract owner to review the policy after delivery and return it for a full refund of premiums paid if they decide it's not suitable for them. This period typically ranges from 10 to 30 days, depending on the state, providing a crucial consumer protection. Always inform clients about their right to review the policy carefully during this period. Question 19. If an annuitant dies during the accumulation period of an annuity, what typically happens to the annuity's value? A. The contract is terminated with no payout. B. The cash value is forfeited to the insurance company. C. The accumulated value, or the premium paid, whichever is greater, is paid to the named beneficiary. D. The annuity automatically annuitizes and begins paying income to the annuitant's estate. Answer: C. The accumulated value, or the premium paid, whichever is greater, is paid to the named beneficiary. If an annuitant dies during the accumulation period, the annuity contract typically includes a death benefit provision that pays the accumulated value of the contract, or the total premiums paid less any withdrawals, whichever is greater, to the designated beneficiary. This ensures that the savings accumulated in the annuity are not lost, providing a benefit similar to a life insurance policy during the accumulation phase. This feature adds a layer of protection for the annuity owner's loved ones. Question 20. When recommending an annuity to a client, which concept is paramount for the agent to consider to ensure the product meets the client's needs and financial situation? A. Maximum commissions earned. B. Suitability. C. Product novelty. D. Lowest surrender charge. Answer: B. Suitability. Suitability is the paramount concept when recommending any financial product, especially annuities, which are long-term contracts. It requires the agent to gather sufficient information about the client's financial situation, tax status, investment objectives, risk tolerance, and liquidity needs to ensure that the recommended annuity is appropriate for them. Failing to recommend a suitable product can lead to significant financial harm for the client and regulatory penalties for the agent. Always put the client's best interest first. Question 21. What is the primary tax advantage of an annuity during its accumulation phase? A. All contributions are tax-deductible. B. Earnings grow on a tax-deferred basis until withdrawal or annuitization. C. Withdrawals are always tax-free. D. Death benefits are exempt from federal estate tax. Answer: B. Earnings grow on a tax-deferred basis until withdrawal or annuitization. During the accumulation phase, one of the primary tax advantages of an annuity is that the interest, dividends, and capital gains earned within the contract are not taxed until they are withdrawn or when income payments begin, allowing for more rapid growth through compounding. This tax-deferred growth is a significant benefit, especially for long-term retirement savings, as it means your money can grow without being reduced by annual taxes. Question 22. Which party in an annuity contract is responsible for making the periodic payments once the annuitization phase begins? A. The annuitant. B. The beneficiary. C. The owner. D. The insurer. Answer: D. The insurer. The insurer, or the insurance company that issues the annuity contract, is contractually obligated to make the periodic income payments to the annuitant once the annuitization phase begins. The insurer assumes the longevity risk, guaranteeing payments for the specified period or the annuitant's lifetime, regardless of how long the annuitant lives. The insurer is the backbone of the annuity's promise, ensuring a steady stream of income. Question 23. An annuity used to fund a qualified retirement plan, like a 401k or IRA, is called A. Non-qualified annuity. B. Qualified annuity. C. Fixed annuity. D. Immediate annuity. Answer: B. Qualified annuity. A qualified annuity is an annuity contract used to fund a qualified retirement plan, such as a 401k or IRA, meaning it adheres to specific IRS rules for tax-advantaged retirement savings. Contributions to these annuities may be tax-deductible, and all distributions, both principal and earnings, are generally taxable in retirement because the funds were never taxed up front. The term qualified indicates it's part of a government-approved retirement plan with specific tax treatments. Question 24. Which type of annuity would be most suitable for an individual who wants to participate in market growth potential but is risk-averse and unwilling to lose their principal? A. Variable annuity. B. Fixed annuity. C. Indexed annuity. D. Immediate annuity. Answer: C. Indexed annuity. An indexed annuity is typically the most suitable option for an individual who desires participation in market growth potential while also ensuring principal protection. Unlike a variable annuity, which exposes the principal to market risk, or a fixed annuity, which offers no market upside, an indexed annuity credits interest based on a market index's performance while guaranteeing a minimum interest rate, floor, that protects the principal from market downturns. It offers a balance of growth potential and security. Question 25. If an annuitant chooses an installment refund payout option, what happens if the annuitant dies before receiving payments equal to the original purchase price? A. All remaining payments are forfeited to the insurer. B. The designated beneficiary receives the remaining payments in a lump sum. C. The designated beneficiary continues to receive the remaining payments until the original purchase price has been fully paid out. D. The annuity contract is transferred to the beneficiary, who then becomes the new annuitant. Answer: C. The designated beneficiary continues to receive the remaining payments until the original purchase price has been fully paid out. With an installment refund annuity payout option, the insurer guarantees that the total amount paid out will at least equal the original purchase price of the annuity. If the annuitant dies before receiving payments equivalent to their initial investment, the designated beneficiary will continue to receive the same periodic payments until the full purchase price has been returned. This option ensures that the annuitant's principal is fully returned, either to them or their beneficiary.